So it's the middle of July in Fishersville. It's hot, it's humid, it's summertime. And today I want to talk about something that's pretty boring, like watching grass grow or watching a game of chess. Bonds, which last year had their worst year since 1780. And, bonds were expected to do really good this year, and they haven't so far. For the first 6 months and 3 weeks as we tape this, bonds are up less than 3% this year. Now, 3% to some people sounds really good, but I think we were expecting this year somewhere in the area of 10% this year. Last year, the aggregate bond index, the Bloomberg's aggregate bond index, last year lost 13%. Boy, that's a tough one. That's like getting run over by an NFL football player and having your teeth knocked out, among other things. So this year we were expecting a good year because we expected interest rates to go down this year. Interest rates have been stubborn. We thought going into this year that we would see interest rates on the 10-year Treasury drop from 4.5% to maybe 3%. Well, right now we're at about 3.9%. So, but the good news is that's the first half of the year. I actually think that bonds are going to be a good performer the last half of the year. I don't necessarily agree that the Federal Reserve should be raising interest rates, continuing to raise interest rates. I think they've already done too much. I think they've done more than enough. And I think that they'll probably raise rates in the next 10 days. And then I think they might wait and see before they raise in August or September. But it looks like the consensus is that the Federal Reserve is going to raise interest rates 2 more times, which may not be great for stocks, but I do think it's going to present a really good buying opportunity for bonds. So why invest in bonds? Let's throw last year out. Last year is that outlier year. Normally, you own bonds in a diversified portfolio so that when stocks go down, normally, bonds go up. Not last year. But I think that bonds still hold a place. They're for people who want income and need income. And generally speaking, bonds have always historically been safer than stocks. But also, let me just give you a little tutorial today about bonds. There are about 13 different bond markets in the world. You have U.S. Treasuries. You have the mortgage-backed securities, Fannie Mae, Freddie Mac. You have high-grade corporate bonds, investment-grade corporate bonds. You have high-yield corporate bonds. You have floating-rate corporate bonds. You have Treasury inflation-protected securities to protect you against inflation. You have foreign government bonds of every nation in the world. You have foreign corporate bonds. You have short-term, long-term, high yield. The word high yield is lower-rated corporate bonds. And I'm sure as you're listening to this, you say, well, how do you choose a bond fund? If you think in terms of investing in a bond mutual fund and you're looking for a total return bond fund, you're going to have a little bit of all those markets. And in addition to having those markets, you're going to have bond funds that have different maturities in their bond funds. Some bond funds are long-term, 10 years or more. Most bonds are in the intermediate area, which are 3 to 7 years. And then you also have short-term bonds. But let's look at it this way. Bonds are designed for people who want and need income in their portfolio. Bonds are really good at absorbing the shocks in the stock market. And they provide a way to give people income to live off of. So I believe that this year has been an okay year for bonds, up about 2.3 to 3% this year. for a little over half the year. I think that at worst, bonds will perform at 5 or 6%. At best, bonds might still hit that double-digit number. So the last part I would say about this is you should never put all your money in stocks. You should never put all of your money in bonds, unless, of course, you're a youngster like Tyler, my buddy who's taping me today, who is, I believe, got 30 years under his belt now. And he would be investing in stocks every day, all day. His daddy might own some bonds. His grandfather might own a lot of bonds. So listen, investing is 3/4 common sense, diversified portfolio, be patient in down markets, be disciplined not to panic when you'd want to, and if you're diversified, you'll likely win in this game of investing. So I hope your week goes well as we're winding down the summer, and I'm looking forward to the NFL football season, college football, and all the other baseball playoffs. It's a great time if you're a sports nut like I am. And I hope you certainly this Sunday, church, it's the best thing you could be doing in a crazy world that we're in right now is finding a good church. The one I go to, Bridge Christian Church on Goose Creek Road in Fishersville. We got a few more seats available this Sunday, and we'd love to see you there. We'll talk to you later.
Securities and advisory services offered through LPL Financial, a registered investment advisor. Member FINRA and SIPC. Cornerstone Wealth Advisor Group is a separate entity from LPL Financial. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. During this segment, we may discuss specific investments. These discussions are for general information only and are not intended to provide specific advice or recommendations for anyone listening to the show. Please consult a qualified legal, tax, or financial professional prior to investing to determine what is appropriate for you. Investing involves risk, including loss of principal.